Something historic is unfolding, and most people don't even see it. The US dollar is experiencing its sharpest decline in over 50 years. Behind the scenes, China has quietly dumped billions in US debt. On Wall Street, they're already whispering a phrase that should send chills down every investor's spine. Sell America. What was once unthinkable is now unfolding at breakneck speed. Countries that once upheld the dollar as the bedrock of the global economy are quietly stepping back. Simultaneously, American investors are pulling their money and moving it overseas. The confidence that held the system together for decades is fracturing, and it's not hard to see why. In just the first half of 2025, the dollar has dropped 10.8% in value against a basket of major world currencies. If you started the year with $1,000, by July it's only worth $890s on the global stage. Over 100 vanished. But this isn't just about numbers on a screen. It's about the global economic order coming apart at the seams. This isn't just the worst start for the dollar in over half a century, it's a warning shot. Not since 1973, when the US severed ties with gold and ended the Bretton Woods system, has the foundation of the dollar looked this fragile. And make no mistake, this isn't the result of a single event. It's the outcome of years of reckless policies, ballooning government debt, endless spending, and a growing global suspicion that the US can no longer manage its finances responsibly. Nowhere is that message louder than from Beijing. While Washington shouted about tariffs and trade wars, China moved quietly, with cold precision. In April 2025 alone, China offloaded $8.2 billion worth of US Treasury bonds. That wasn't just a sale. It was a signal. They're done backing the US financial system. And this wasn't a sudden decision. It's been building for years. Back in 2012, China held over $1.3 trillion in US government debt. As of April 2025, that number is down to just $757 billion. That's a staggering 44% reduction over 13 years. Over $600 billion sold off. And they're not stopping. China is shifting its focus inward, prioritizing its domestic economy, and distancing itself from dollar dependence. The question now is, what happens when others follow? If foreign governments begin selling off US debt in large volumes, America faces a brutal reality. Borrowing money becomes more expensive, harder to secure, and the consequences ripple through everything. The entire US system is built on debt, and the belief that someone, somewhere will always be willing to lend. That belief is now in question. The US is spending far more than it collects in taxes. To stay afloat, it borrows constantly, issuing Treasury bonds, essentially IOUs. These bonds fund everything from military operations to Medicare, public infrastructure, education, and social safety nets. And who buys them? Countries like China, Japan, and the UK. When they lend, they're not just investing. They're keeping the US government functioning. But with US national debt now over $37 trillion, the cracks are widening. Every year, hundreds of billions are borrowed just to pay interest and maintain basic operations. And all of it relies on one fragile assumption, that the world will keep buying US debt. But what if it doesn't? Yes, the dollar is still the dominant global reserve currency. Yes, Treasury bonds are still considered safe. But that faith is no longer rock solid. Inflation, political chaos, and strategic rivalries are pushing countries to rethink their exposure to US assets. If they start to exit en masse, America is trapped between two equally dangerous choices. Hike interest rates sky high to attract buyers, making the debt even costlier. Or print more dollars, which floods the system and risks inflation spiraling out of control. Either way, the outcome is ugly. The Treasury bond market is the spine of the entire US financial machine. If it buckles, borrowing stops. If borrowing stops, the government freezes. Programs halt. Salaries go unpaid. Projects collapse. The unthinkable becomes possible, default. Not from a developing nation, but from the United States of America. While all this chaos played out in headlines and markets, China was executing a quiet, deliberate strategy. As Washington looked outward, China turned inward. While the Fed juggled interest rates and Congress argued over spending, China was buying gold, silently, steadily, and in massive quantities. Over the last 3 years, the People's Bank of China has purchased more than 210 tons of gold, not just as a hedge, but as a weapon, as a statement, as preparation for a world where the dollar is no longer king. The shift is already happening. What we're witnessing isn't just a currency wobble. It's the early stages of a global realignment. The fall of the dollar is no longer a theoretical risk. It's becoming a lived reality. And the world that comes next may look very different from the one we've known for decades. China is quietly executing one of the most aggressive gold acquisition strategies the world has ever seen. Every month, it's buying roughly 80 tons, about $8.5 billion worth. And there's no sign of it letting up. These aren't symbolic purchases. This is a deliberate shift, a strategic transformation in how China secures its wealth and prepares for an uncertain financial future. By early 2025, the country's official gold reserves had already crossed 2,300 tons, a number that's staggering on its own. But even that may not reflect the full picture. Many believe the real volume is significantly higher, with additional purchases potentially routed through state-controlled banks or made offshore, away from the visibility of international financial reporting. This isn't just a financial maneuver, it's a message. A message about trust, sovereignty, and survival. Why gold? And why now? Because gold is the oldest, most proven hedge against instability. It answers to no government, no central bank, no election cycle. It cannot be devalued with the stroke of a pen or the slip of a politician's tongue. It isn't dependent on GDP forecasts or Federal Reserve press conferences. It doesn't crash with tech stocks or evaporate in geopolitical shocks. Gold is not just a commodity to China, it's a shield. And the urgency behind this accumulation tells a deeper story. China has watched the weaponization of the US dollar with growing alarm. It's witnessed Washington cut off nations from the global financial system, impose sweeping sanctions, manipulate trade flows, and isolate entire economies, all through control of the dollar and the SWIFT network. The realization is chilling. The global reserve currency is no longer neutral. It's a tool of power, and it can be used at any moment against those who dare to diverge from American interests. For China, the answer is clear. Reduce exposure, pivot hard toward autonomy, and use gold to anchor the future. But China isn't alone in this recalibration. Something larger is unfolding, something global. In boardrooms and private banking offices, on trading floors and inside family offices, a quiet but decisive shift is taking place. Wealthy Americans, too, are showing signs of deep unease with the direction of their own country. Billionaires, CEOs, hedge fund titans, they're no longer just hedging. They're moving capital offshore in volumes not seen in decades. The year opened with cautious optimism. Inflation appeared to be slowing, markets flirted with recovery, and whispers of a soft landing circulated in financial media. But by mid-year, the narrative changed. Fast. Major U.S. fund managers began cutting dollar exposure. Wall Street insiders gave the moment a name. The Sell America moment. It wasn't a blip, it was a signal. A signal that faith in America's financial trajectory was faltering at the top. Policy chaos played a major role. Unpredictable moves by Donald Trump, intensifying trade conflicts, and ongoing disputes with allies all fed into the growing uncertainty. A Gallup poll added hard data to the anxiety. More than half of Americans now say their financial situation is worsening. Fewer than a third believe markets will recover soon. And these are no longer just abstract concerns. They're being reflected in action. The ultra-wealthy are reallocating assets overseas, increasing their holdings in gold, buying up foreign real estate, and securing second passports as insurance against future instability. Visa programs offering second citizenship have seen demand from Americans skyrocket, up more than 1,000% since 2020. In Asia, the story is similar. Family offices are openly unloading U.S. equities and redirecting capital to Japan, China, and European markets. BNP Paribas confirms it. This isn't an exodus driven by panic, but a deliberate rebalancing away from what's now perceived as American risk. According to Bank of America, nearly $9 billion exited the U.S. stock market in a single week. That's not market volatility, that's structural distrust. And it's not just the loss of investment, it's a redirection of belief. The beneficiaries are clear. Japan pulled in $4.5 billion during that week alone, a record not seen since April of the prior year. Europe took in another $3 billion. It's a flood of capital flowing toward what's perceived as safer, more stable shores. The rationale goes deeper than trade wars or election cycles. Many funds now believe U.S. equities are wildly overvalued, artificially inflated for years by low interest rates, stimulus, and speculative optimism. But those days are over. Inflation may be easing, but rates remain high, and large institutional capital is no longer willing to bet on hope. It's hunting for value, for governance, for predictability. Japan, once dismissed as an aging, stagnant economy, has emerged as an unlikely safe haven. Quiet reforms, price discipline, and new corporate governance standards have flipped the script. Investors have been pouring money into Japanese equities for 10 straight weeks. Europe is on a similar path. While far from perfect politically, its regulatory and fiscal posture feels less erratic, more long-term in vision. Governments are investing heavily in infrastructure, renewable energy, and defense, not just as economic stimulus, but as strategic imperatives. Once viewed as liabilities, these now look like opportunities. Even more telling, foreign investors haven't completely turned away from the U.S., at least not yet. Bank of America reports that while American investors were retreating, Foreign entities actually funneled nearly $4 billion into U.S. equities. But that optimism had limits. U.S. Treasury bonds experienced their largest weekly outflow since 2020, a worrying sign that even traditionally safe American assets are losing their aura. Gold, surprisingly, also saw a rare weekly outflow, the first since January, suggesting that investors are becoming even more selective about where and how they protect their capital. What we're seeing now is no longer a portfolio reshuffle. It's a structural reorientation, a historic migration of wealth from one center of gravity to another. In 2025 alone, over $100 billion has flowed into European equities and funds, triple the amount from the same period last year. At the same time, the U.S. recorded $87 billion in capital outflows. And it's not just money that's leaving, it's conviction. For decades, the idea that the U.S. would always lead, always recover, always attract the world's capital was an unquestioned belief. That assumption is cracking. For the first time in a generation, the world is openly wondering if the United States is still the financial anchor it once was. The new reality prizes predictability over dominance, long-term planning over short-term stimulus. In this environment, it's Europe and Japan, not the U.S., that are looking like the centers of tomorrow's capital flow. Bank of America isn't waiting to find out. It's already restructuring its entire European trading infrastructure, aiming to become one of the top 3 financial players on the continent. That's not a tactical adjustment. It's strategic groundwork for a future where global capital no longer reflexively flows to Wall Street first. So the real question is no longer whether investors are pulling back. They are. The question now is whether this is temporary turbulence or the beginning of a new global order. Can Washington restore confidence and recalibrate the system? Or has the pivot already begun, quietly and irreversibly? One thing is certain, the long-standing faith in American economic supremacy is eroding. And for the first time in decades, the search for alternatives isn't happening in the shadows. It's happening in full view, and this may be only the beginning.